Hello, good afternoon. You've tuned into MF Corner on CNBC TV18 and I'm Vinny Motiwala in the Mumbai studio. Today we're going to talk about an interesting topic that is going to be the dividend yield funds. And when you look at dividend yield funds, they've received an inflow of around 215 crore rupees in the month of November and from a decline that we're seeing coming in from the month of October where it was 532 crore rupees. Though these funds are typically more stable than other equity funds, they come with certain risks. Today, we will try understanding how these funds differ from regular equity funds, the key investment strategies, and the associated risk with this. And to talk to us about all of this, we have our experts joining in with us. We have Varun Fatehpuria, founder and CEO at Daulat Finvest, as well as Ridhi Kanoria, co-founder at Lxme, joining in with us. Good afternoon, both of you all. Thank you so much for joining in with us, as always. And, let's start by talking about the basics. What are dividend yield mutual funds and how do they differ from regular equity funds? Varun, let's start with you for the day.
Yeah, thanks, Vinny, for having me back on the show. As you correctly mentioned, dividend yield funds, as the name suggests, invest predominantly in dividend yielding stocks. Now, if you look at what exactly is dividend yield, let's just look at the definition. It is a financial metric that measures the percentage or the quantum of the dividends that are paid out by the companies relative to its stock price. So naturally, these companies are more mature, cash-rich, stable businesses that have been in the business for a sufficiently long period of time. And if we look at it from an AMFI categorization point of view, these schemes are mandated to invest at least 65% of the corpus into equity or equity-related instruments of dividend-yielding companies, right? So that is roughly what dividend yielding as a category, as a scheme stands out for. And if we compare it to, let's say, a more regular equity mutual fund, right? Again, these are diversified equity mutual funds, sector or market cap agnostic. So it's not a large cap or a mid cap or a small cap focused fund. They have the flexibility to sort of paint the brush across the sector wherever they are able to find those stocks that have a high dividend yielding compared to, let's say, more like growth focused funds, which do not focus so much on the dividend yield side of things. So that's plain and simple. These schemes are mandated to invest only in companies typically which have a high dividend yield compared to other stocks.
Right. Ridhi, I think Varun has covered most of the aspects, but anything that you would like to add to this? And, I'm going to ask you, what is also the typical investment strategy of these funds when it comes to it?
Got it. Yeah, I think Varun has covered most of the points. But the investment strategy, I think, is very interesting because I think while it is focused on equity funds, it focuses more on slightly more mature companies, stable companies which have a history of profitability and a history of paying out dividends. So therefore, they are less affected by volatility and more stable generally in the long run.
Okay, more stable in the long run is what you're saying. Varun, anything that you would also like to highlight, especially in terms of a strategy that comes in from these funds? What are these fund managers normally looking at?
So again, I mean, typically, if I were to compare it to, let's say, a more regular equity mutual fund, these companies, because let's say, I mean, why do companies pay out dividends? Typically, if they're not able to reinvest that profit back into the business, let's say, due to the nature of the industry itself, or the sector, let's say something like a utility sector or a power sector operating in well-regulated industries, which have that regulatory sort of tailwinds with them and have that predictable cash flows, these companies are essentially then able to pay out a percentage of their profits to shareholders as a way of rewarding them to being invested in these companies. And that is what also the schemes tend to typically also look at, since they are investing in more mature, stable, cash-rich businesses, companies with a significant history of, driving shareholder returns, paying out profits over a period of time. So if I want to still compare it, let's say in the large cap category, we could slice and dice it over there, more mature, stable companies. That is what the scheme is focused on. Second, where it typically stands out compared to the broader benchmark, Vinny, is the broader benchmark is typically, let's say, more indexed towards financial services, right? Today, right? But these companies, let's say, have a higher percentage of allocation to something like a power company, NTPC, NHPC. Again, these are not stock recommendations, but typically where they have more of their exposure, because these companies tend to pay out a higher percentage of the profits as dividends back to the shareholders. So again, just across the market cap, across sectors, with focus more on high dividend paying companies.
Varun, I just want to follow up on this, question as well. Does this also include, some of these companies, which are looking at buybacks? Does it form a part of this as well?
Yes, absolutely. I mean, now buybacks are also a way of returning cash, returning, returns back to the shareholders. So schemes also have the flexibility to look at companies which are doing share buybacks, since that also drives the overall total yield or the returns that the company is able to generate back to the shareholders, and is a measure of the profitability or the return ratio. So they could look at either dividend yield itself or also percentage through share buybacks.
Okay. Ridhi, what is it that, we spoke about all this, in terms of highlights that are coming in of why and what would be the strategy. But what is it that attracts a fund manager in this as well? For going for these high yields, what is it that dividend yield stocks or these funds, what is it that attracts them?
Got it. I think one is basically the higher potential returns from other popular products like FDs. Secondly, the stability of the company, right? The fact that they are stable, they do have consistent profits. At the same time, they also ensure regular income in the form of dividends. So for certain categories of investors, that is actually, for example, someone who wants to retire and have a stable form of income along with capital growth. So I think they have a balance of both regular income and capital growth.
Okay. Regular income and capital growth is something that you think is something that would attract these fund managers as well. Varun, anything you would want to... Ridhi, please go on. I think you're saying something. Sorry.
Yes, and also I think there is less volatility, right? Because generally the companies that the fund managers are looking at are more mature companies. They do have consistent profits. They have shown consistent growth. So they are less volatile, for example, in a bear market than other growth stocks. So I think also the stability that brings and security that brings.
Okay, so steady income, financial stability, less volatility, 3 points coming in, which you've highlighted, Ridhi. Varun, anything more that you would like to add to this as well?
Today, Vinny, again, I think if we want to look at it from, let's say, a factor perspective, these would slice right in between the quality factor, which is sort of making a comeback today after 2 to 3 years of significant underperformance compared to, let's say, value or growth, right? So that is why today also, if you look at why fund managers today or investors in general are attracted to the dividend yield category, is also due to the quality factor, which is coming into rotation. Again, quality, we know, typically measured by return ratios, return on equity, return on capital deployed, low levels of debt, professionally run, well-managed companies, right, paying out consistent profits. So these are some of the reasons why fund managers also tend to be attracted. And second, as we have mentioned, again, I mean, it's literally hard cash that is coming out of these companies, and cash is something that cannot be manipulated by the management, right? So that is also a measure of the financial health of the company itself.
Right. Varun, what investors should actually be looking at these dividend yield funds? Anything specific in terms of a profile that they should be having? Or what is the sort of investor that should watch out for this one?
So, Vinny, I think what typically how it has been marketed, or where a lot of the misconception comes into the industry, is people look at it from a regular income or an alternative to a fixed deposit, fixed income product, which in our view is not a correct categorization. Because the underlying holdings of these schemes still tend to be equity instruments, which are subject to the market risks, right? So as an investor who's, let's say, slightly more conservative, looking to dabble into the equity markets for the first time, or have, let's say, a slightly lower risk appetite compared to, let's say, more sector-focused funds, the mid-cap, the smaller cap categories, for them, this could be a really good starting point to get taste of the equity market, since they provide you with that equity exposure, but at a significantly lower beta or the volatility compared to the broader market itself. And that's reflected in the risk measures of these funds as well. So our opinion is, for investors who are slightly conservative, wanting equity exposure, equity allocation to the portfolio, but with a slightly lower amount of risk, for them, dividend yield funds are a very, very attractive category to consider.
Okay, less risk appetite. If you're diving in for the first time into the equity markets, where not much of a, risk that one could take, is something that you could watch out for. Ridhi, would this be suitable for someone if they're in their 20s? Does it make sense that you could look at this and or retirees? Is that an option coming in? Anything specific on that front? On, if a young investor is looking at it, you don't want to take the risk, but you want that higher return. So what should you be looking out for?
So on that, to add to what Gaurav said, I think investors that have a relatively lesser risk appetite are suited, and they're looking for a balance between generating income and moderate growth, right? Because it's lesser volatile. However, investors, they get the regular growth only if they opt for IDCW, which is your income distribution cum capital withdrawal plan for payouts, right? Also, we do think that investors should invest in this with a longer term horizon. We do think it should be more retirees and lesser younger 20-year-olds. The 20-year-olds ideally can invest in the higher growth equity options because over a longer term, that should give a higher return. So if you're looking for higher growth, higher return, this might not be the right fit. If you're looking for a lesser risk, moderate return, and generating income, this would be a better fit.
Okay, surely. Thanks for that. And Ridhi, that is Varun on the other side as well. But on that note, we're going to sip into a very short break, viewers. Don't go anywhere because we still have a lot to discuss on this topic, dividend yield mutual funds. So we'll be back after the short break. Welcome back to MF Corner on CNBC TV18. On the dividend yield mutual fund topic, we finished talking about what it means, what is it that the strategy that is applied, who could be looking at investing it. Now let's talk about the risks, because we do have our experts who are still with us, Varun as well as Ridhi, to solve all those questions. Varun, key risks that come in with investing in dividend mutual funds. What is it, the major one?
So just like other diversified equity mutual funds or equity just as a broader category, one of the risks that the dividend yield funds are also exposed to is the market risk and the volatility, right? Any of the events today that are taking place, whether from a macro perspective or general broader economical perspective, the dividend yield funds are also equally exposed to that, though with a slightly lower level of volatility. That's number one. Number two, the sectors itself could be slightly more concentrated since the schemes focus more on companies which have a higher dividend yield ratio, and the companies typically tend to be concentrated, let's say, in sectors like utilities, power companies, real estate, staples, IT. So it is important to understand the sectoral composition of each of the schemes as well, to see whether the schemes are sufficiently diversified or not. And more likely than not, since the companies tend to be in pockets in specific sectors, there could be a potential of sector concentration at the scheme level. And number two, there could be a potential for underperformance, let's say, in a more growth-focused market where, let's say, growth-focused schemes tend to typically outperform quality or, let's say, dividend yield as a strategy, where the market is rewarding companies which are reinvesting their profits back into the growth of the companies. Now, since these businesses tend to be in a more mature, stable businesses with limited opportunity to have an expansion, at that periods of time, depending on what the market cycle is, there could be a potential to underperform the broader market as well. So these are the three risks, in our opinion, that investors should look out for.
Okay, so market risk, sector concentration, as well as possibility of underperforming when growth funds are doing well. Ridhi, anything more that you would like to add to this in terms of the down cycle? Maybe that comes in for specifically companies themselves as well, and that could maybe impact dividend. Is that something we watch out for?
Yes, of course. So also dividend is not guaranteed. So companies during an economic downturn might reduce or stop paying dividends altogether. So while we are focusing on that, it's not a guarantee like, say, an FD where you get a confirmed interest, right? Also, for example, there's a huge strategic change for a particular sector where they need to actually invest their profits back into the business. So in that case, also, along with economic downturns, there might be dividend cuts where then the end investor does not get a dividend.
Right. Ridhi, just one question. Like, obviously Varun was also mentioning before that, this is not something that you should compare with FDs. But what is just that approximate, return that you normally get in these dividend yield funds? How much is it that on an average of 3 to 5 years that we would look at?
So actually, yearly, it's a lot lower, which is, I think, 1 to 3%, but please correct me if I'm wrong. So it is a lot lower than FDs. But the thing is, you do have capital appreciation in this, which can be substantially inflation beating, right? Which you don't get in FDs. So which is why this is actually a great option, also an alternative to FDs.
Okay. Varun, I just want to ask in terms of right now, we see a lot of volatility in the market, right? Now, when you're talking about growth-oriented funds, you know that directly, most of it would see an impact. But in dividend yield funds, is there any difference in terms of the market volatility or how it affects these funds?
No, I think, again, because these are the underlying itself tends to be equity-related instruments. So they're obviously they're exposed to the same market risk that all other schemes or stocks in a mutual fund basket are exposed to. But to the earlier point, the volatility or the beta of the scheme or the fund itself could be slightly lower than one, given the schemes are concentrated around companies which are stable, cash-rich, mature businesses. So what it does is, let's say, in a more volatile market, for investors, it helps them to essentially protect the downside and limit the downside risk. There will still be downside, just to sort of put it out there. It is not that the schemes or the strategy itself is immune to any sort of a volatility. There will still be downside. It is just that when the market, let's say, falls by 10%, these funds could fall by 5%, right? So in a bearish market, these funds typically tend to protect your downside better. And that also on the flip side, when the market then simply tends to rise and there is slightly lower ground that they need to cover, right? So that is one advantage, that something that falls less needs to rise less to get to a level set.
Okay. Ridhi, just want to understand your take on this as well. And what are your thoughts on, market volatility and these funds?
So this is equity linked. It is market linked. Right. So there is, of course, a potential downside, but it's generally less volatile because of the category of companies we're investing in. They are stable, they are profit making, they have a history which they've proven. So they are definitely less volatile. Also, the second thing is dividends actually do provide a cushion against falling stock prices. Right. And like Varun said, they do drop lesser. So then the rise needed is lesser. So then generally they have been more stable historically.
Okay. Varun, dividend mutual funds, you said do not compare them to fixed deposits, right? Now, talk to us about the risk of risk-adjusted returns for these instruments when you have versus another income-generating instrument. What is it that is a difference on that front?
Okay, so if we look at, let's say, dividend yielding, right, there are a couple of ways through which investors today can actually get regular income, so to speak. One is through the SWP route, where effectively you are redeeming the units based on a percentage withdrawal that is flexible to what you need, right? And the other is the income distribution cum capital withdrawal option, where the dividends itself are not guaranteed, since any of the payouts are effectively paid out of the net profit or the distributable reserves of the mutual fund schemes. Now, this could vary depending on from scheme to scheme, from fund house to fund house, depending what the frequency is. But let's say if I want to take a very specific example of, let's say, a UTI dividend yield fund, right? They have been distributing income anywhere in the range of about 5 to 7% over the last 10 to 15 years on an annualized basis through their IDCW option, right? Now, if investors want to do a like-to-like comparison to, let's say, something like an FD, right? If an FD is giving me 7% with my capital being protected, but at the other hand, an equity-related instrument is still giving me a 7% payout with the opportunity to participate in the upside over a longer period of time, then obviously this as an option starts to look attractive. But obviously investors need to keep in mind that this is something that is not guaranteed. Just because the schemes are earning dividend, they are not basically mandated to pay out any sort of the distributions as a payout. So again, in our opinion, we would keep both of these options different.
Okay, just one quick follow-up for you, Varun. What would be the percent of allocation if someone is around 40 and 50 that should come for dividend yields?
So in our opinion, we would slot them in right into their equity allocation into the large cap bucket, right? So if anyone is into their 40 to 50s, having a 50 to 60% allocation to large caps, right? This could be a good complementary strategy. And given again where we are today, As I mentioned, quality seems to be making a comeback, right? So people could also look at dividend yield as a tactical play for the next 15 to 18 months or even perhaps 2 years. So I would sort of fit this into my large cap bucket or even my multi cap bucket within my equity allocation.
Sure. Okay. That's all the time we have on this edition of Mutual Fund Kano. A lot more to discuss on this topic. But thank you so much, Ridhi, as well as Varun, for joining in with us and helping us understand what dividend yield mutual funds mean and who should be investing it. But that's all the time we have on this show today. Thank you so much for tuning in. Stay tuned in for Closing Bell up next.